I think if you look at what's happened in the first half of this year, so I think Europe in terms of retail investment has seen almost 15 billion euros of investment, and it's of little surprise that 60% of that remains in the UK and Germany. And I think that's a trend that has continued throughout the downturn, and UK and Germany really do remain the darlings of the investment community when it comes to retail investment. We're also seeing markets within the CEE region come back, so also sort of quoting that first half year of 2013, CEE was the third most invested region, heavily dominated by Russia, but we believe that the interest in Poland and the fundamentals that they can give you from a shopping center perspective and a consumer perspective, we will see much more activity in Poland in Q4. I think in terms of secondary locations, I think you touch on something quite poignant at the moment, and I think whilst a number of people are very focused on prime, that scarcity of stock and the increased amount of capital that chases that scarce amount of stock, it will mean that investors will have to start looking outside of the comfortable spectrum and move towards a riskier position. And I believe that what we're going to see is a bleed out of that core headspace and into the secondary sectors. We're seeing it in Germany. We're definitely seeing it in the UK. Yields are coming in. Finance is more freely available now on secondary stock, and I think long will that continue, and it's certainly a sector that we see almost outperforming core if you buy the right secondary with the right fundamentals, and that really is the key point. Secondary is such a vast array of stock, but if you have the right location, and I think your description is perfect, dominance or convenience. If you get the right fundamentals in the right location, secondary stock should not be feared and will perform.
Maybe as a background information, we own 40 shopping centers all over Europe. That provides us with a quite good basis to act opportunistic. So opportunistic, I don't mean opportunistic investments, I mean core investments, but opportunistic in terms of location. And actually I disagree a bit with my neighbor here. I think like there's no point about talking about secondary, because like it's the matter of catchment, and as long as the catchment is good, we don't care if it's like one of the major capitals of a country. So I think like with retail, you always need a bit you need to be a bit like careful in talking about secondary. Actually, if the catchment is good, if the demographics of the catchment are fine, the purchase power actually that is what matters with retail, and that's where we'd like to invest and to be there. And in this regard, we can act opportunistic. Whether there might be let's say good opportunities in the Nordics, maybe, why not? But there may be also in other, let's say, undervalued regions of Europe, like Southern Europe, even a bit more like CEE apart from Czech and maybe Poland. So I think there will be opportunities also moving forward next year.
Interesting. I mean, we did a CEE briefing last week, which you can read actually in the current issue of the magazine, but we did a CEE briefing which was interesting because in that there was definitely a feel that some of those areas of CEE that really have been not viewed well at all in terms of investor sentiment, now people are beginning to come back in terms of financing and also beginning to look at things again that nobody had been looking at for the last kind of probably 2 years almost, I should think, if not longer.
I think like reason for that was that there were enough of opportunities in the core Western markets. So as long as these opportunities disappear or they're getting too expensive, I mean, we all need to diversify.